Thank you so much, Amy, for the nice introduction, and welcome everybody to CPA Australia's webinar on Demystifying Decentralized Finance. My name is Dr. Jana Schmitz, and I'm the Digital Economy Policy Lead at CPA Australia. We have people joining us from all over the world for today's webinar on DeFi. And before we kick off, I would like to take a moment to acknowledge the traditional owners from around Australia and pay my respects to elders past, present, and emerging. And I extend this acknowledgement to all Aboriginal and Torres Strait Islander people who may be joining us today. It is now my pleasure to invite Dr. Anton Didenko, who will be our guest speaker today. Anton is a senior lecturer at the Faculty of Law and Justice of the University of New South Wales, specializing in banking and finance law with a particular focus on fintech, regtech, and cybersecurity. And before I hand over to you, Anton, just a quick reminder for everyone that today we will be taking questions through our chat box, which you can find at in the bottom right corner. Please direct questions to all panelists, and we will address them at the end of the session today. For any troubleshooting queries, please just send a message to the host using the chat box. And yeah, that said, I hand over to you, Anton, to commence the presentation. Thank you.
Thank you, Jana. I've taken control of the presentation. And thank you, everybody, for joining this session on decentralized finance, or DeFi for short. Sometimes when I participate in discussions on DeFi, on the concept of DeFi, these discussions are reduced to topics like cryptocurrency, tokens, digital tokens, or blockchain. Well, this is not the intention for today. I don't have any doubts that crypto assets have many potential uses. It can be used in land registries, central bank digital currencies, and so on. But our focus is on a particular use case involving crypto assets, that is decentralized form of finance. And full disclosure, I will approach this topic as an academic specializing in financial regulation. So I have no stake in crypto, and I have no stake in promoting or supporting or advising the DeFi ecosystem. And I guess for this reason, this session, I hope, will flag some of the existential problems existing and surrounding the DeFi ecosystem and DeFi applications that, in my opinion, the DeFi world has not come up with an answer yet. So we'll start with the concept of DeFi, and I'll say a few words about what I like to refer to as the boundary problem of DeFi. It's distinguishing a decentralized finance from traditional finance, and whether that is an easy task. Then a few words about the common DeFi applications and perceived benefits of DeFi for the traditional economy. And then the particularly important part of the session will be a discussion of the risks that DeFi presents to the traditional centralized finance and the potential regulatory response that might be developed in response to these risks. So to kick off with a definition, what is DeFi? Well, as the name suggests, DeFi refers to a decentralized form of providing financial services. But decentralized finance has existed well before crypto assets and blockchain, we know crowdfunding, for example. So what do we mean when we refer to DeFi these days? Well, there seems to be a broad consensus about some of the key features typically associated with the DeFi ecosystem. The first of all is the fact that these services are typically provided by multiple entries and eliminate or reduce the number of intermediaries. So disintermediated design is a critical feature, and non-custodial design as a result. Another important aspect is the use of smart contracts on a blockchain to record the relevant transactions. And I probably don't need to stop and talk about smart contracts at length here, just flag the common understanding, I hope by now, is that smart contracts not really smart, not really contracts, it's just algorithms, computer code that follows very simple, straightforward if then scenarios and then implements those transactions based on that if then approach. And another important aspect of DeFi is the so-called open and composable architecture, sometimes referred to as the Lego of finance. It means that there are different layers and you can build applications on top of those layers, and those layers easily interconnect. So what is the boundary problem that I flagged at the beginning? Well, the important thing to start off is to mention that there's a surprising lack of clarity regarding the boundaries of the DeFi ecosystem. And this is because the distinguishing features, characteristics of DeFi don't really relate to the nature of the relevant products, which largely remain the same, but rather to the new ways of delivery of those products that we already know very well. And so since the products and services largely remain the same, it can get really challenging to distinguish the different forms of DeFi applications from the centralized finance. And this is what I refer to as a boundary problem. And as you can expect, in finance, the boundary problem can be easily abused by market participants. So startups and different projects can arbitrarily market themselves as being DeFi for marketing purposes without necessarily being truly decentralized, being truly disintermediated, as the common features suggest. And in a sense, this reminds me of the blockchain craze we used to have, 4 or 5 years ago. Maybe we still have it, um, where businesses left and right were marketing themselves as being based or implementing the blockchain technology, even if it had very questionable benefit to those businesses. I still remember the example of Long Island iced tea maker that changed the name of the company to include the word blockchain on the day, and that led to the rapid increase of capitalization. I think 200% raise very quickly. And in that sense, if we remember those lessons in the context of DeFi, I'd say just the flavor of the month may change, but the problem largely remains the same. But terminology is different now. And another important thing to consider is that decentralization, even if it's on a blockchain, is rarely absolute and typically exists on a spectrum. So the question then is, at which point does the relevant service become sufficiently decentralized? So is it sufficient that the service is provided by 2, 10, 100 entities? So what is the threshold? Well, it doesn't exist. It's not prescribed. And also, even in so-called self-proclaimed DeFi applications, there is almost unavoidably some degree of centralization going on. So, for example, the developers of the DeFi applications, the relevant protocols, can retain some of the control over the system. For example, by controlling administrative keys, they give them administrative privileges, allowing to change the product, change the code as they deem fit. So in a sense, the true DeFi, so to say, could be said to be a purely theoretical construct. This is something to bear in mind when we talk about the regulatory approaches to decentralized finance. As for applications, actual real life applications of DeFi, then I've listed some of the examples on the screen. I think the more prominent examples are on the slide. And I should probably start with stablecoins. Stablecoins, as I think many will know, are crypto assets that are designed to preserve their value by maintaining a peg to some other asset or maybe basket of assets. And they're typically used in the DeFi ecosystem as collateral to provide liquidity within the system. And the logic seems to be pretty straightforward. Stable coins are crypto assets that are perceived to be more stable, have more stable value, and that means that they better serve the function of a store of value. Even though in practice, realistically, they can be sometimes pretty bad at fulfilling that role, but I suppose stable coins are better than purely decentralized cryptos like the Bitcoin, given its massive swings in value. But then stable coins are not the same. They can implement varying levels of decentralization that depend on the stabilization mechanism they implement. Some can be backed by non-crypto assets, which means that they're managed off the blockchain involving intermediaries, and that effectively serves as a link of DeFi to the traditional financial system, centralized financial ecosystem. But other stablecoins seek to maintain their value by maintaining an over-collateralized pool of crypto assets and essentially allowing the stablecoin holders to seize the collateral if the collateralization value falls below a certain threshold. Now, exchanges, I won't say a lot about exchanges, just enable the trading of crypto assets, but decentralized exchanges seek to do this by eliminating intermediaries. So they avoid taking direct custody of the crypto assets. But lending is particularly important. Lending is one of the largest segments of decentralized finance today by volume, offers quite attractive interest rates, but DeFi loans, even though they share the fundamental characteristics of traditional loans that involve the repayment of principal and interest, they operate on a pseudonymous or anonymous basis, if you will, on the blockchain. So there's a catch. The lenders don't know who the borrowers are, and that means that they can't really assess the creditworthiness of the borrower. They cannot verify it. So there needs to be a solution, and the solution comes in the form of over collateralization again. That means, if you want to borrow a certain amount of crypto assets, you have to post collateral, which typically exceeds the amount of the loan significantly. It could be 5-to-1, could be 6-to-1. And this is really where DeFi lending effectively reverses the process we have in traditional unsecured lending. So disintermediation implies that lenders do not have access to credit reporting data, and this really produces the process that some of my colleagues have referred to as disintermediation without information. And in a sense, this means that the need to post collateral in the lending space is a significant barrier for wider adoption, because collateral-based lending effectively works for those who already have sufficient assets who can afford to post sufficient collateral. So this really excludes those of little wealth. Derivatives and insurance really mimic the traditional finance, and derivatives, for example, can be managed largely on some of the derivatives can be managed largely on chain. Others rely on external data feeds, known as oracles, that are needed to verify that the event that triggers the payment, for example, has really occurred. Asset management also typically mimics the traditional practice of allocating financial assets with a particular long-term strategy, but without a custodian, which means that in practice, crypto assets are being locked in a smart contract that follows certain pattern of if-then rules. And finally, auxiliary services. This refers to the external data feeds of the oracles that I mentioned. And these are sometimes necessary in the DeFi ecosystem because it is a source of trusted information. But by definition, oracles serve as trusted intermediaries, and this introduces the external third-party dependencies, which the DeFi ecosystem largely seeks to get rid of. So what about the prospective benefits? If we listen to proponents of the DeFi world, there are vocal proponents. By the way, there are a number of prospective advantages. I think the crucial one refers to the perceived improved efficiency of the financial ecosystem that can be produced as a result. This is largely due to disintermediation. The decentralized finance essentially replaces centralized intermediaries with smart contracts. So the expectation is that the smart contracts that follow very strict rules can assume the role of custodians, escrow agents, centralized counterparties, you name it. And also, disintermediation is said to reduce counterparty risks because of the so-called atomic settlement, which is conditional settlement, implying that either both transfers take place at the same time or neither of them takes place. Also, a perceived efficiency advantage is the fact that asset management can be streamlined by enforcing a predefined set of rules through the smart contracts. And also, there's an expectation as the DeFi ecosystem grows, there'll be more and more participants, so this will increase the transaction speed due to automation and the reduced concentration in the financial services sector. So no longer dominated by, say, the big four banks or whatever number that may exist in other countries. So another perceived advantage is the enhanced resilience. Again, as a result of disintermediation. The expectation is that the custody chains will be shortened and that transparency will be increased. And so this could decrease the potential risks to liquidity problems. So essentially, DeFi can produce a system with no central point of failure and no centralized target for cyber attacks, in theory. And I guess another perceived advantage in the current climate, geopolitical climate, is that DeFi can potentially enable a financial system that insulates finance from intervention by some of the key financial centers, as can be seen in the recent successful attempts to freeze and other sovereign reserves, national reserves of central banks, for example. Yet another perceived advantage is greater transparency. And this really refers to the fact that blockchain data is typically publicly observable, so it can be checked, and the coding as well is often open, non-proprietary in many smart contracts. So the advantage essentially comes in the form of greater availability of historical data about the economy, both before and during any crisis. So it could make the information easier to obtain for the regulators as well. Increased accessibility and inclusivity is another perceived advantage. And this really refers to the fact that DeFi protocols are anonymous, or pseudonymous, if you will. And they can be used by anyone. So potentially DeFi could facilitate a financial system that's open and accessible for everyone. And in that ecosystem, as long as it's completely anonymous, there's very low risk of discrimination or due to the lack of identities. And finally, the thing I referred to at the beginning, the composability of DeFi, this Lego system, where you could where the functional interoperability between different layers in the ecosystem offers an incredible level of structural flexibility. You can build different Lego pieces on top of each other and share some of those parts of the ecosystem, like shared settlement layer. So there's a lot that can be potentially achieved by taking advantage of the DeFi flexibility and disintermediation. But at the same time, if we look at the real use cases of DeFi, then in practice, it seems to be, at least to me at this point, that it largely supports speculation and arbitrage across crypto assets at this level of development, not necessarily, I'm talking about the future. So the DeFi is enabled by the proliferation of crypto assets, and those crypto assets are making their way into traditional financial system. And at the same time, the regulators are trying to do their best to navigate their mandate, not just to protect consumers, for example, but all the financial system, but also to promote competition. And it seems like a lot of regulators are struggling with this. Even in the centralized finance space, even when there is an intermediary that's easy to see, such as the centralized crypto exchanges. And we all know what this can lead to in the wake of the recent FTX collapse. So even in that space, even in centralized space, we see a lot of issues and regulators trying to address those problems, not always very successfully. So you can imagine it's going to be even more problematic in a disintermediated space, in a DeFi context. And another thing to consider is that the framework, the DeFi ecosystem is changing rapidly and new developments all the time. And if I were to, there are different attempts to create a taxonomy of different types of risks. I'd like to refer to four groups of risks: is technology and operational risks, financial stability risks, legal risks, and market integrity and governance issues. So I'll talk about each of them. And I think this is a really important part of today's discussion. So technology and operational risks. There are a few of them, and they're particularly important because of the whole idea that the technology and smart contracts on the blockchain will replace trusted intermediaries. And the first of those limitations, I guess, is the protocol limitations. And one of the obvious problems is that there needs to be a sufficient level of decentralization for many of the protocols to work. There needs to be critical mass of nodes on the blockchain to successfully implement the consensus algorithm, whatever it may be. It could be proof of work, proof of stake, or whatever. So if you don't achieve that level of scale, then you essentially produce a largely centralized system that's vulnerable to so-called 51% attacks, where you can just take over the blockchain and add the transactions you think are important, and overtake the building process of the blockchain. And another problem refers to so-called network congestion. And network congestion is essentially a period where the number of transactions on the blockchain exceeds the network's capacity to process those transactions. And since the people, the intermediaries effectively that are acting as validators, the miners, need to be compensated for their work, this typically leads to a proportionate increase in transaction fees that are paid for the processing. And this creates a problem, especially when the fees themselves are managed by a smart contract. And so it can lead to very quick increases, rapid increases in the fees, and the users may find very quickly, in a matter of minutes, hours, maybe even seconds, who knows, that even the standard procedures like withdrawing funds or adding funds are suddenly subject to very high fees on the platform. And this problem is really not something we talk about in the traditional finance, the traditional payment system, for example, where we already have real-time gross settlement in most countries for large value payments, and also fast payment systems like Australia's NPP, New Payments Platform, which already operates on a 24/7 in a 24/7 mode. So we don't really stress that much about suddenly incurring unforeseen fees and worrying about the payment not really coming through. And in contrast, if we consider blockchains, such as the Bitcoin blockchain, for example, then recording a transaction on blockchain is not really a definitive guarantee that the payment of the transaction itself is final. According to some experts, you need actually to wait for a particular number of other blocks to be added beyond your own to be more or less safe, and to know that this blockchain will not be overtaken by another, and suddenly, which would lead to your payment disappearing from the correct blockchain. So that is really a big problem, considering that we don't really deal with those problems in traditional finance. Another issue is what I like to refer to as a basic infrastructure. So there are many DeFi applications out there, But all that activity is typically concentrated on a very small number of protocols, and also there's a very small number of providers of basic infrastructure like Ethereum. So this effectively means the DeFi ecosystem, at least now, vulnerable to platform downtimes. And in addition, many users don't really interact with the platform by themselves. They rely on other intermediaries that do it for them. That really exacerbates the problem. And another issue, a particularly important one, I think, is the inflexibility of smart contracts. Now, the main, one of the biggest advantages of the smart contract is that it's predictable. So there's deterministic and predictable rules-based execution you can rely on in a smart contract ecosystem. But at the same time, this really creates big issues it's probably one of the biggest weaknesses in the ecosystem. So if the blockchain cannot be changed, if it's immutable, as they say, then following coding errors or malicious cyber attacks, end users' crypto assets end up being irreversibly destroyed or permanently immobilized, never to be accessed again. And on some DeFi platforms, the developers actually pride themselves on the fact that they don't have the ability, the technical ability to roll back transactions, even if those transactions are clearly fraudulent. And in some of DeFi applications, the apps themselves, they request and permissions from end users to transfer an infinite number of tokens. And that means that the entire amount of investment can be lost very quickly. So again, this inflexibility of smart contracts is another example where DeFi may struggle with the problems we don't really deal with routinely on a traditional financial ecosystem, or when we deal with them, we have a solution through things like emergency liquidity assistance, deposit protection schemes, and so on, litigation if necessary. So in a sense, this inability to reverse clearly fraudulent transactions makes DeFi applications incredibly poorly suited for anything but speculation. And this, it's likely to make the other perceived benefits of DeFi almost obsolete for most end users, because DeFi largely prioritizes the integrity of the ecosystem, of the blockchain, over the elementary notions of fairness or common sense. And in practice, it may lead to the conclusion it may protect criminals at the expense of honest participants. And this is really a big thing if we consider it in the large, in the greater scheme of things. Now, technical complexity is another issue. Now, they often say that transparency of the DeFi protocols is a big advantage, but yes, it is, definitely is. But for consumers, it really offers little, if anything, at all, because the average consumer will not have the technical capacity to process and read the code. Or to verify the integrity of the code. And so in the absence of trusted intermediaries, in the absence of licensed intermediaries that people can rely on, because license means you command some authority, you can be trusted. Retail investors are likely to make their investment decisions based on things like third-party endorsements on Twitter or disclosures from platform developers, whether they can be trusted or not. And in this context, this perceived complexity of smart contracts, or smart contract code, differs substantially from the legal contracts, if you think about it in that way. Because, yes, legal contracts can be complex to understand for the consumer, but they're still written in natural language. It means that at least the fundamentals of the contract can be understood by the average consumer. Whereas if it's programming code, the risk is the consumer will not understand any of it in its entirety without special training. And again, traditional finance establishes various safeguards against that prevent consumers from interacting with products that are not clearly suited for them. And I guess the most recent example in Australia would be the design and distribution obligations in the law that require developers to consider whether a particular product is objectively consistent with its target market and what the target market wants or expects from the product. It's quite important. And another aspect, I think, which creates an existential threat to DeFi in this setting would be cybersecurity. Well, first of all, cyber attacks on the DeFi ecosystem are very common and financially attractive. And there's problem with the reporting. We don't really know the exact number of attacks, the losses, but the reported losses, at least for the years 2020 and 2021, exceed $200 million US. That's a lot. But we're not sure that, this is the exact number. Nobody knows the exact number, I suppose. And one of the critical vulnerabilities in the system is Oracle data. That's external data feeds. Since Oracle data can be used to influence reference prices and trigger liquidations of collateral very quickly. But cybersecurity also presents a unique challenge in the DeFi ecosystem because of this transparency. Transparency, on the one hand, doesn't really do a lot to the average consumer, but it does a lot for the experts in the field. Some of them can be engaged, of course, by the developers to find weaknesses, but another group will be the cyber criminals who will be looking at the code in its entirety and seek vulnerabilities. And also, I guess ironically, the decentralized nature of DeFi applications makes them particularly vulnerable to cyber threats. If it's a decentralized framework we're talking about, where multiple users make decisions at the same time, it means that it may be this entire community can be very slow to react to cyber attacks like ransomware attacks, where you need to make a decision reasonably quickly, whether to pay the ransom or to not to pay the ransom. And so, I guess ironically, the DeFi, this fully decentralized governance model seems to be at its weakest when the need to act is urgent, because cyber criminals are not really limited by those things. They can hit where it hurts. And I guess the biggest problems in this context is the so-called assume breach approach. This is really a dominant approach in cybersecurity regulation and also in some of the standards, international standards in cybersecurity, which essentially refers to the acknowledgement that it's impossible to build an impenetrable cyber fortress. And that means every computer system will be breached at some point, just a matter of time. And since the blockchain nodes, the blockchain themselves, as they say, are immutable, and you cannot make changes to the system, and sometimes it's an objective fact. This really puts us in a very complicated situation, because the assumed breach then becomes the existential challenge to the DeFi ecosystem, because it implies that each DeFi application is not only unsafe by definition, but also will produce losses unavoidably that will be unrecoverable in the event of unavoidable cyber breaches. And this really, I guess, promotes opportunistic get in, get out quick mentality instead of posing a genuine challenge to the traditional financial ecosystem. In terms of financial stability risks, well, there are a couple of those. I would refer to excess volatility and costs. DeFi ecosystem is highly susceptible to fluctuations in the valuation of crypto assets, even though stable coins sometimes seek to somehow remedy the problem. But even the most widely known and widely used stable coins like Tether experience major issues. And there was an investigation by the Attorney General of the state of New York, which revealed that the stable coins, the Tether's issuers experienced massive liquidity issues over time, and that contrasted very significantly with the very positive public statements they were putting out for the general users. And so the high volatility of stablecoins that are backed by traditional assets can actually set off investor runs, and those investor runs may lead to the race to be the first to recover the collateral. And in traditional finance, we don't really have that much of an issue in those situations when there is, say, deposit insurance. So there are certain aspects of traditional finance that safeguard from this risk, in a sense. Another problem really is the recent increase, the gradual increase in the volume and in the size of transaction fees. It used to be a couple of cents, say on a Bitcoin, on Ethereum blockchain at the beginning, and now it's dozens of dollars per transaction. What the result is the pricing out of smaller, especially retail investors who refuse to trade at higher fee values, and that effectively locks in their investment, their balances in their accounts. This is a big problem. And of course, systemic risks are potentially a big issue. And if you think about it, the composability of the DeFi ecosystem and the resulting systemic risks have a lot in common with what we observed pre-GFC with the derivatives market, because it's very easy to repackage, to create new tokenized assets on the basis of other tokenized assets. And one of the examples would be so-called liquidity shares that are received by providers of the liquidity to a decentralized exchange that can be redeemed for a share of that collateral of the liquidity pool. These liquidity shares can be traded on the secondary market in exchange for second generation of liquidity shares, and then third generation of liquidity shares, and so on and so forth. So this generates a whole range of so-called wrapper tokens that can obscure the true levels of exposure in the DeFi ecosystem, not dissimilar to what we observed with the derivatives pre-GFC. And add to this the fact that we don't have a stable lender of last resort in the DeFi ecosystem, and we have systemic risks. And again, in traditional finance, the measures, the response to that problem is often by prudential regulation of trusted of critical intermediaries within the system. But DeFi seeks to get rid of intermediaries, so we have a very big issue. And another aspect I would just briefly mention is the excessive leverage. Yes, there is over-collateralization that is required within the DeFi ecosystem, but at the same time, the borrowed funds can be almost immediately used again as collateral for other transactions. And collateral effectively serves as the only shock-absorbing instrument in the DeFi ecosystem, which it makes it really unattractive compared to traditional finance, where we have commercial banks and central banks acting as shock absorbers in the system. And the legal risks. Well, I don't want to maybe repeat the obvious ones, the regulatory access points. It's very difficult to understand who to regulate in the DeFi ecosystem, right? And the securities laws and disclosure requirements often predate the DeFi and distributed decision-making platforms, which means that they do not really account for the specifics of DAOs, for example, decentralized autonomous organizations, where the management is very different compared to typical centralized corporations. So they might need to be adjusted. AML CTF laws are particularly important. This is what I'd like to focus on very briefly, because some aspects of the DeFi are intentionally built to be obscure, and that is the ownership or control of the nodes. And this makes it very difficult to enforce the rules, AML CTF laws in particular, in case the DeFi ecosystem is abused for illicit purposes. And there was quite an interesting example in August this year, where I think it was one of the first examples of trying to enforce the law or the rules against a decentralized protocol, when Tornado Cash was put on the SDN list of the United States Office of Foreign Assets Control, of the OFAC. And the unusual characteristic here was that Tornado Cash is not an individual. It's not a company. It's a cryptocurrency mixer, essentially a non-custodian platform built on Ethereum that allows different users to deposit Ether and then withdraw Ether. That helps them obscure the origin of funds of that crypto asset. And so if you look at the designation, there's no individual name there, there's no company name there, but the designation by OFAC really refers to a long series of digital addresses on the Ethereum blockchain. And it's questionable how effective it was, but at least in the short term, this led reportedly to a significant reduction in the amount of crypto assets used within the Tornado Cash platform. Now, consumer protection is a big issue, obviously, and I think I referred to the relevant issue several times. Data privacy, regulatory arbitrage. Well, this is really a challenge because you don't really know whom to regulate. And I think it's worth mentioning that even the most advanced legal systems today don't really try to effectively regulate decentralized finance. And for example, if we refer to the MiCA regulation, the Market and Crypto Assets Regulation of the European Union, then at least the most recent language of it expressly excludes DeFi from regulation. It excludes crypto asset services provided in a fully decentralized manner without any intermediary. And finally, the last point here would be just to say that enforcement is a problem. Even if you identify the entity you can apply the law to, then the regulators will typically not have the resources or the tools to stop or curb the unlawful activities. So that's a big challenge. And finally, the last group of issues would be market integrity and governance risks. Now, even though we say that there are no intermediaries on the platforms, well, there are validators, there are miners or other validators on the system that effectively serve as intermediaries, and the entire platform, the blockchains, are reliant on the faithful observance by these intermediaries of their mandate or their function. And unfortunately, in the DeFi ecosystem, this function has been abused a number of occasions, since validators can choose what transactions get added to each particular block. They can effectively front run. So they can abuse the time lag between the time when the trade was placed and the time the trade was added to the blockchain. And this creates what some experts call minor extractable value. But I think one of the biggest problems really is the governance, whole governance of the DeFi platforms. DeFi platforms often start as centralized at the development stage, but then gradually become more and more decentralized. And if you trust the developers, but the problem is even that the so-called fully decentralized platforms can still keep a large degree of influence by the original developers. This could be as a result of concentration risks. For example, the developers can accumulate a very large number of governance tokens at the beginning, and even though there are different nodes, on paper you can see that the governance nodes are spread across a large number of participants. You don't really know how many nodes are controlled by a single entity, which could be the developer. And another problem here is the administrator level control. And that means that developers may not really have a legal obligation no formal duty to implement whatever decisions the decentralized group may make. So in that sense, that the control may be only nominal or superficial, and administrative permissions that administrative keys give the developers can give them an incentive to go rogue. And also in a number of platforms, it can be very difficult to actually establish the fact that there are administrative keys in place. And so as a result, we sometimes see very unfavorable status quo, I would say, where prospective investors are dealing with risks they don't understand on the platforms controlled by people they do not know, and all the while, the legal protections that traditional finance don't really apply, and that is a challenge. And so this really brings me nicely, I guess, to the regulatory and policy tools for DeFi that can be implemented. Well, I guess the starting point would be the functional approach to regulation. This is where the regulation typically starts. Whether that is sufficient is a big challenge, especially things like administrative keys are not really factored into existing traditional functional approach to regulation. So we might need to rethink that. And another thing to remember is that DeFi is really a developing concept. So what we think about it now may be outdated tomorrow. In my view, consumer protection aspects need to be prioritized. So yes, there are teething problems within the ecosystem, and they may be resolved in the future. But right now, there is immediate danger for consumers that interact with the platform they don't really, with the risks they don't really understand. And this is, to me, challenge number one. Systemic risk prevention, well, there have been proposals on how we deal with systemic risks. For example, a starting point could be dealing with the exchanges first, and also maybe imposing prudential requirements on the banks interacting with the DeFi ecosystem. But for me, like the most important takeaway, for example, the proposed takeaway would be the need for ex ante regulation. When people talk about DeFi, I think the general perception is wait and see. Let's wait and see how it develops because it's not large enough at this point. But I would say that we really need to regulate, to try to regulate certain aspects of it ex ante, for at least for two reasons. First, DeFi applications start centralized and then become decentralized. So you could begin early. And second, it could be useful to start to steer the development of the DeFi ecosystem in a certain direction. The regulators can do this at an early stage, especially if they use things like regulatory sandboxes. And this brings me to the conclusions, the slide with the summary of the main points. And I'd like to stop here and ask Jana whether she has any questions or are there any questions I could respond to right now.
Thank you so much, Anton. That was a really, really insightful presentation. And Amy is going to post a link to the report that Anton wrote for CPA Australia on DeFi right into the chat box. Good timing, Amy. Thank you. So to the audience, if you want to gain a bit more in-depth knowledge about decentralized finance and also learn about the current policy and regulatory environment, as well as the risks and benefits and other topics, please have a look at the report, which was published this morning. So thank you so much, Anton. And I just want to remind everyone in the audience that we have another 11 minutes to take some of your questions. So please feel free to post them into the chat box in the bottom right corner. And whilst you're doing that, I'm going to make use of the time and ask Anton a couple of questions that I came up with during the presentation. So, Anton, the crypto ecosystem, including the DeFi market, have been under significant pressure, especially recently, which was partly or is partly due to the collapse of the centralized exchange FTX. To what extent do you believe that this event, the collapse, affects the crypto market or the ecosystem in general? And do you expect the market to grow or to stagnate or to decline even?
Thank you. Well, okay, yes. The first thing I would note that the collapse of FTX refers to the problem at with the centralized crypto exchange. So it's not really as complicated as the DeFi ecosystem, where decentralized exchange, we don't really know who controls the nodes, who's in charge, so to say. But still, I think that the FTX collapse is going to accelerate the ongoing tightening of the regulatory framework. We already know that there is MiCA regulation that I mentioned, developed in the European Union. And in Australia, we had a public consultation earlier this year on so-called CASPs, crypto asset secondary service providers, and the regulation of them. Again, both initiatives refer to regulation of intermediaries, intermediated ecosystem involving crypto assets. So I foresee the accelerated regulatory measures, but the issue here is that regulators don't really want to sound anti-crypto, anti-innovation. That's really a challenge we see also all the time. So they're doing their job. They're very intelligent. They're very professional. That's great. They just between a rock and a hard place, so they need to listen to this vocal minority and try to appease to them in a sense to promote the competition in the market. But I think the collapses like the FTX one, they are going to make it increasingly difficult for even for vocal businesses to oppose the change we're seeing. And this change, I think, will come first to centralized finance involving cryptos, like the MiCA regulation, the crypto asset. Maybe we will see the next iteration, a new consultation, maybe the law on crypto asset secondary service providers, hopefully at some point. As for DeFi, it's going to be more challenging, but I think it's the low-hanging fruit is those centralized intermediaries, and then maybe we'll see something happening in the DeFi space. But again, it's a long way to go. So I think, yeah, it's probably stronger regulation, and finally, a good reason to not listen to the vocal proponents and actually do what the mandate tells
Yeah,
to protect the
exactly.
consumers, especially. That's my take at least.
Thank you. Thanks, Anton. And that's a great segue also into a topic that Mark touched on in his question. So Mark says, so in summary, is there a future for cryptocurrencies or will this fade out? And I'm even going to take this question a bit further and add, if this doesn't fade out or if this fades out, do accountants still need to learn about this? Like about cryptocurrencies, or do they still need to familiarize themselves with crypto in general?
I absolutely think that crypto is with us to stay. Even the DeFi world, even though it's somewhat on the fringes of the financial system right now, is with us to stay. The question is in which form. Um, there are very valid uses for crypto assets. As I mentioned at the very beginning, I alluded to this. Central bank digital currencies, and where some crypto assets can be used to digitize real world assets and to make settlement much more easier. So that much more easily. So that is the really important. There are really important use cases for cryptos, and they are with us to stay. Technology may change. We might develop something other than the blockchain and smart contracts, which seems to be the flavor of the month right now, or flavor of the year, or maybe many recent years, but who knows what will happen afterwards. Um, but there are real existential problems that needs to be solved. For example, for the DeFi ecosystem, the biggest one of the biggest problems I mentioned was the conflicts between deterministic execution of the contract on the one hand, and the elementary notions of fairness. How do you compensate those who have been robbed? Put very simply. So there needs to be a balance. If there is no balance, there's no future. But if we see a meaningful answer to these fundamental existential problems, then we shall see. So either the DeFi ecosystem, for example, will continue to grow and will be um, a worthwhile parallel financial ecosystem, but it could easily be what it is now, essentially a small fringe market for selected speculation-driven investors and doji developers. And I think the answer largely lies in the fact whether the demand for a more efficient financial system is going to be satisfied by the regulators, by the central banks, and so on. So, is there financial inclusion? Is there immediate settlement in the? Is there? Are we still relying on T+1, T+2, and so on, or is the settlement actually atomic? Is there programmable money? So, if the formal financial system provides the answers to these issues, I think there'll be much less demand for this alternative decentralized finance, and it's largely just to stay a fringe market, a very small thing for speculation-driven doji investors and doji developers.
Yeah, great answer, Anton. And your comments already touched on Mark's second question in regards to what the government is going to do, or if it continues down this path. So you've covered that. And just to add here, that in Australia, the Commonwealth Treasury is going to put out a public consultation paper, Mark and everyone else on the call, on a what is called token mapping exercise. So the government is trying to map out the operational and economic characteristics of different, well, let's call it subsets of crypto assets. But we will probably not see that coming out this year. So it will be most likely this next year, I suppose. But yeah, we will see. Another question that just came in, Anton, from Ninji, is what do you think will be the spillover to the rest of the market by the fall of FTX? And will we see a Lehman Brothers type of market meltdown? So in other words, is there a spillover, a contagion effect of the crypto markets affecting the traditional financial markets? And how is that going to play out?
It's hard to say at this point. It's not the first crypto exchange that has fallen over time.
The domino effect, yeah.
Yes, yes. It's not the first one. We haven't seen a major domino effect. We've seen, one falling over. Alternatives are being created on the spot because in crypto asset world, in the crypto, not just crypto asset, but cryptocurrency world, it's very easy to create a new crypto asset out of thin air, not supported by anything, and create an alternative trading platform on top of that. So I guess, obviously lessons have been learned. People who have been following the market, I hope, at least consumers, have learned their lessons and they will steer away from some of these platforms that they don't know how they operate. But at the same time, there are still many others that are still using and are relying on this whole ecosystem for speculative purposes, and it doesn't look like there is a major problem. So within the decentralized ecosystem, don't see that much. Yes, the fall of one token often leads to the fall of another one. That has happened. For example, the Luna token example, you can look it up. It was quite an interesting example, and I refer to it in the report, by the way, because we don't really have enough time to discuss at length. So yes, there are like smaller domino effects where connected crypto assets fall over, and we have this chain, the wrapper tokens. Yes, but the ecosystem itself seems to be going, because there are just new tokens being created, and so you don't really need to back them up with anything. So it's very easy to. As for the impact on the centralized finance, well, we don't have too many connections yet to the centralized finance. Maybe stable coins backed by some real world assets, but the spillover effects are not as significant, but they might increase over time, I guess.
Thank you, Anton. And we have time for one more quick question with a 30-second answer. Sorry to put you under pressure. NFTs, and how will they be affected?
NFTs, again, two use cases, just speculation or a very valid instrument to protect the author's rights to their creation. I guess any collapse of the decentralized, and they really rely on the decentralized ecosystem. So I see that there's increasing sophistication of NFTs going forward, and this is a good thing because there are multiple alternative platforms being developed. So there is a development in this space, but the failures of FTX and centralized platforms and any issues with the DeFi, they showcase much the same problems that NFT framework is going to be subject to in the future. So the lessons are going to be the same, implications are likely to be the same. But again, we see that the space is developing, and it's sort of reassuring, I guess, that we see additional platforms, and so the infrastructure becoming more diverse. It's very hard. I guess all the same issues I described here are likely to apply. The caveats I mentioned here are going to apply.
Thanks, Anton. And I read somewhere recently that the big corporates like Qantas, for example, they are getting into it. They find some kind of use case for NFTs. So we will certainly see more of it in the future. but we are already over time. I apologize to everyone on the call. Thank you so much, Anton, for sharing your insights. And again, please, everyone, have a look at the report. It's a really, really insightful one. And yeah, thanks again for joining us today. And I'll hand it back over to Amy. Thank you.
Thank you. Thanks, Jana. Thanks, Anton. And thanks, everyone, for your participation today. In the next 3 working days, you'll receive an evaluation survey accompanied by the recording of this webinar. We really appreciate your feedback as it's extremely important to CPA Australia to help us deliver better events for you. Thanks again, and we look forward to welcoming you to another CPA event soon.